Hello and welcome to this episode of Nothing Ventured with me, Aarish Shah. We've somehow managed to make it to December 2025, and I think we need to talk about what has just happened. Venture came to a grinding halt in 2023 as everything seemed to crash. Whilst most people spent 2024 standing around in the hopes that things would somehow get back to normal, 2025 seems to be the year that we all accepted that not only wasn't normal coming back, but maybe our whole understanding of what was normal was flawed to begin with. At least that is for most of us. Because 2025 has been the year of what we can only really call the Great Bifurcation. Why? Because from everything that we're seeing and that's happened, the market seems to have split clean in two. On one side, the wannabes, AI rappers, growth at all costs SaaS companies that never managed to find product market fit. And let's face it, they've been relegated to the dustbin of history. Dead, kaput, insolvent, done. On the other side, we've got biology companies designing drugs with AI, defense tech building out sovereign infrastructure, hardware companies raising billions, and foundational models receiving millions, strike that, multiples of billions in funding. Not just at day one, but often before there's anything to even invest in. For them, it's like the boom never really stopped. Most of the market isn't going through a recovery. Rather, like some weird Harry Potter-esque hallucination, it's going through an extended, often brutal, sorting. And not everyone is making it through to Hufflepuff. Because the market, or at least those investors with the capital to deploy, is deciding what matters and what doesn't. And this year, they have been absolutely ruthless about it. Here's how I would propose we break the year down. 5 acts. Act 1, the AI split. We both saw how Builder.ai collapsed, whilst in the same year, Ilya Sutskever raised at over a $30 billion valuation with no product. Act 2, the biology boom. London companies have raised over $2 billion for life sciences, but it feels like barely anyone noticed. Act 3, the age of the sovereignty stack. Defense and energy have somehow become the only safe harbors, whilst everything else has either burnt to the ground or is slowly collapsing in on itself. Act 4, the European paradox, the question that everyone in Europe is being forced to ask of themselves: are we building powerhouses or instead just incubating companies for American VCs and then the public markets to buy? Act 5, the 2026 outlook and why SpaceX's IPO may actually save the entire market. So with that in mind, let's start where the bifurcation really began and what has been dominating everyone's minds, from VCs to founders, large corporations to their employees, and increasingly politicians. AI. Act 1, the AI split, when diligence came back. 2025 may be the year when diligence came back, at least to some extent. For some, it came harder and faster than it did for others. And nothing captured that better than Builder.ai. The faker. Builder.ai, established in 2016, for many years, was one of London's tech darlings. Backed by Microsoft, Qatar, amongst others, it promised what others have since been able to deliver via Natasha, an AI that would build apps for you. Just describe what you want and the AI does the rest. Magic, right? Wrong. In May 2025, they filed for insolvency and the whole thing collapsed. Why? Well, because it turns out that Natasha wasn't a neural network at all. It was allegedly hundreds of human engineers in India and a lot of spreadsheet wrangling. This was like a Theranos moment for AI, when its fake it till you make it era ended. If margins depended on hidden human labor dressed up as algorithms, then 2025 really did kill you. But this wasn't just Builder.ai. It clearly got much of the press given the astronomical amount of capital raised, if nothing else. Across the market, AI wrappers, basically ChatGPT built on UI and a prayer, got wiped out. Diligence started to return, and investors stopped asking founders to show me the demo and started asking, show me the model weights. On the other hand, you have the God, safe superintelligence. But as in life, so in venture. Everything requires a balance, and here's where the split gets interesting. Whilst the fakers and the wannabes went to zero, the supposed gods went to infinity. Ilya Sutskever left OpenAI, started Safe Superintelligence Inc., and by February 2025, there were reports of a valuation of well over $30 billion. They didn't have a product, they certainly didn't have any revenue, just a deck, a philosophy, and Ilya's brain. $30 billion, to parrot Elon for a second, let that sink in. On the one hand, you have diligence coming back in to repair past successes, but on the other hand, you have this blind faith capital, complete with wings, prayers, and a heck of a lot of cash. It's as if the market decided that there are maybe 5 or 6 humans on Earth who actually matter when it comes to AI. And investors have been willing to write GDP-sized checks to them regardless of any data to warrant those investments. Ilya raising at a valuation of $30 billion plus, Mira Murati raising $2 billion at $10 billion, and no doubt others in pseudo-stealth mode raising eye-watering rounds with capital concentrating around the perceived future winners. That's the split. If you're a mere mortal building a SaaS tool, you are fighting for scraps at Series A, if you can get close to raising at all. If you're an AI god with OpenAI or DeepMind on your CV and a theory about AGI, you're raising billions, basically on pure vibes. Like it or leave it, that's where the market is right now. And in 2025, the middle died. The wannabes went to zero and the gods going to the moon survived. Everyone else is stuck trying to figure out what to do next. Act 2, the biology boom nobody talks about. Okay, enough of the doomerism though. 'Tis the season to be jolly and all that, so let's get on to something genuinely positive. Whilst everyone was watching LLMs eat each other, life sciences have had a huge year, even though you'd have needed to be watching to see it, especially in London. The numbers. London raised $2.1 billion in life sciences in 2025, which is more than Paris, Stockholm, and Berlin combined. But unlike trad pharma or biotech, this isn't about we found a molecule. Instead, it's the start of the tech bio era. AI colliding with biology to create biology language models, designing drugs with machine learning, predicting protein folding, running in silico trials before a single human even gets dosed. The headline? Isomorphic Labs. The standout deal was Isomorphic Labs, which span out from DeepMind in 2021. It took its first external funding, and it wasn't a $5 million seed round. No, Thrive Capital, GV, and Alphabet all came in for a reported $600 million. Maybe this is the future of venture, a move away from software eating the world to software healing the world? But cycles always seem like they'll persist in the moment. There's always something shinier or sexier that will come out in the fullness of time. But for now, it's certainly no bad thing that funds are accruing to potentially world-changing technology. Isomorphic uses AI to predict how molecules fold, how they interact, whether they'll actually work as drugs, and are attempting to compress drug discovery from a decade to months. And it was only months after raising that whopping first external financing that they reported that they were nearing their first trials for their AI-developed drugs. This wasn't the only large life sciences round we saw. Pathos AI raised $365 million in a Series D in May for AI-driven clinical trials. And we've been seeing plenty of ventures doing deep science raising lofty rounds. So why does this matter? Well, it feels like this capital might be sticky. Doesn't vanish when rates move a few basis points. These companies are building labs, hiring PhDs, and creating long-term value with the potential for massive royalty streams. And importantly, these companies don't pivot to crypto because someone started shilling meme stocks on X. And from my perspective, the beauty is that London, the UK more generally, and Europe as a whole is actually competitive in this space. We have the Francis Crick Institute, the King's Cross Life Sciences Cluster, Imperial, UCL, not to mention Oxford and Cambridge, producing serious computational biology talent. If you want to feel good about UK PLC, maybe it's time to look at the labs in King's Cross, not just the fintech apps in Shoreditch. In a world where everyone is panicked about being in an AI bubble, biology has just continued to build. Act 3, the sovereignty stack. This is when defense ate ESG. Biology may be a green shoot, but defense is in an iron dome because 2025 was a year ESG has been tossed to the gutter by many, and the hawks have replaced it with national security, sovereignty across the board. So what's been the shift? Not so long ago, VCs were apologetic for investing in defense, if they invested at all. Many would state that it's complicated or we have to think about our brand. But fast forward to today, and right now, it's become something to brag about. And frankly, that's no bad thing. Defense is one place where government contracts real guaranteed revenue can replace shaky consumer demand. Though clearly there is a real concentration risk. You have a few customers that hold a lot of power and ultimately a few defense primes, which are the most likely route to exit. But the reality is that in 2025, Europe collectively woke up to the fact that we cannot rely on the US for defense or on China for supply chain. And let's not get into the problems we have on the energy front. And as these realities sunk in, capital started flowing and following into companies building sovereign infrastructure. We've already seen a few winners. Helsing raised 600 million euros building defense AI for targeting, threat detection, and autonomous coordination. Mistral raised 1.7 billion euros on a European AI sovereignty thesis, the assumption that every region is going to need to be self-reliant on its own foundational models because you never know when policy, domestic or foreign, may shift, leaving you in the lurch. Nscale raised $1.1 billion for GPU infrastructure in the UK, announcing in January this year that it wants to invest $2.5 billion in UK data centers over the next 3 years, with its first UK site already purchased in Loughton. Let's face it, these aren't social networks or fast grocery delivery apps. They aren't consumer apps or spreadsheets with a shiny front end selling B2B. Instead, these are significant infrastructure bets in a world where governments are becoming desperate. The sad truth is that over the last several years, Ukraine has proven that software-defined warfare is not only real, it is developing rapidly. NATO is expanding, and across the board, defense budgets are going up. I mean, just look at 2024, when world military spend jumped to a massive $2.7 trillion, the steepest annual rise since at least 1992. But however much I may wish to champion this move to build tech and infrastructure that will solidify our ability to be self-sufficient, let's never forget that hardware is, well, hard. Lilium, the German electric air taxi startup, filed for insolvency in February after the German government refused a loan guarantee. And in the world of venture, this isn't a unique story. It wasn't that their technology failed, they had working prototypes. Rather, they were failed by the capital markets. In order to get to meaningful revenue, they needed $500 million in capex, and sadly, Europe simply couldn't bridge it. This is the uncomfortable lesson we face in Europe. We have great science, great scientists. We can invent deep tech, even spin it out of the labs, but we struggle to scale it when it needs patient hardware capital. Maybe defense will be different. Defense has government contracts from day one, and if they become a core part of a state's defense capabilities, the risk of failure becomes too great a cost to accept. So maybe that's why money has flowed there in 2025, whilst companies like Lilium sadly died. Act 4, the European paradox. Incubator or powerhouse? This brings us to the big question, one that I have explored all too often on this podcast with a variety of guests. Are we, in Europe, just an incubator for American VCs? It's clear that we can start great companies here. We can scale them to Series A and even Series B here. But then, in a story as old as European venture, HQ moves to Delaware, founders follow suit. We see the Atlantic drift. Cap table turns American, and when it finally comes time to ring that bell, the IPO sadly happens across the pond. We may build them, but it's the US that captures the value. So let's dig in a bit further. The London Stock Exchange had another rough year. Hargreaves Lansdown went private for £5.4 billion. Darktrace is gone. ARM trades in New York. European public markets seem effectively closed to tech. And let's face it, if companies can't exit locally, they don't stay local. The policy response? Well, there are signs that Europe understands this reality. The UK government has been trying. Mansion House reforms are finally moving pension money in 2025. The goal is to unlock £50 billion, which is sitting idle. But let's face it, it is slow going. And the risk is all too obvious. By the time that capital is actually deployed, our best companies have already moved and will be American owned, at least on paper. The verdict? Well, the bitter truth is that we absolutely have the talent in everything from biology to defense, climate tech to deep tech, and even AI. Remind me again where DeepMind was founded? Hell, Europe is capturing 60% of global VC funding in regenerative agriculture. But our problem isn't talent. It never has been. It is the depth of capital we have available and it is exit velocity. This is the paradox we currently have to contend with, and this year has made it even harder to ignore. Act 5, 2026, the SpaceX catalyst. Okay, so what now? Well, 2025 may have been brutal, but as with all purges, its redeeming factor is that it has helped to clear out the dead wood. And despite the mega rounds, which saw a third of all Q3 venture investment go to just 18, count them, that's 18 companies raising $500 million or more, may be the biggest signal for 2026 touchdown just this month. Elon Musk confirmed SpaceX is prepping for a tender offer or IPO around mid-2026 at well north of $1 trillion valuation. Not to quote the big man too often, but let that sink in. So what, you might say? Why does that matter for Europe? Well, maybe because SpaceX becomes the icebreaker. IPO markets have been on ice for 2 years. The window keeps peeking open before getting slammed back shut. If SpaceX trades well, it helps to reprice risk across the board. It's that first domino falling. Databricks could follow. After all, they're back in the market looking for $5 billion just 3 months after having raised $1 billion Series K. Stripe might follow, though signals have remained mixed as to their intentions. And eventually, Revolut follows too. But the most important outcome from these companies going public? LPs get liquidity. Liquidity leads to commitments, and commitments lead to new funds. The cycle restarts because, frankly, throughout 2024 and 2025, the market has been tight. You're either a mega fund raising billions or an emerging fund raising, less than $50 million as a first fund. But all of those funds in the middle, sitting on markups but no liquidity, are struggling to convince LPs why they should invest in Fund 5 when Fund 3 has yet to return any significant capital back to them. So what are my calls for 2026? Well, firstly, the IPO window blows open somewhere between Q2 and Q3. Secondly, in the UK at the very least, biology becomes the new fintech and every generalist fund hires a computational biologist, if they haven't already. Thirdly, true AI wins. We see the death of wrappers. Infrastructure and vertical AI see massive Series B. Fourthly, Europe's sovereignty stack persists and starts to prove itself with real revenue. And what's my final word? Well, let's face it, 2025 has been painful for many of us in the venture ecosystem. If you were a wannabe, if you were mediocre, if you were growth at all costs but with leaky unit economics, the market ended you. But if you survived, you are anti-fragile. Because we've left the era of easy money and we're into the era of important money for health, defense, energy, infrastructure. And that is flowing faster than ever, even if it is far more concentrated than we might want it to be. The bifurcation is done and we know who matters now. So I would hope that 2026 is when the survivors start proving what they're actually worth and start returning cash to LPs, GPs, founders, and employees so that the venture flywheel can start turning properly again. Thanks for tuning in for this Nothing Ventured wrap-up of 2025. Do enjoy the holidays, and let's build something real in 2026. I'm Aarish, and remember, whatever you do, stay liquid.